those who've joined this evening. I'm going to try and keep my comments relatively brief so that you get to hear more from the investment team, which actually is doing all the good work day in, day out. Maybe I start with continuing, continuation of sorts of what we discussed last quarterly connect call, because a lot of people are those who also attended the last quarterly call, where the hot topic of discussion was the the worsening COVID situation and its impact on the market, and so on. So obviously what you see here at the top left-hand side, as well as the top right-hand side, when we last met, the graph was spiking up, right? And then fortunately, we've seen a rapid climb down, and we all are aware that things have normalized very rapidly. So if we go to slide 66, what is also going to help going forward to prevent repeat of this, while there's a lot of, so when wave 2 hit us, there was no worry about wave 2. And now there is such widespread worry about wave 3 that hopefully it would not hit us this time around. And what is going to help quite likely is this relatively higher compared to what was the case in March vaccination rate. About 25% of the people are vaccinated now with COVID vaccines, and then a fairly large number, nobody knows the reality, what is the real number, but it's possibly a similar number of people who've already been infected and hence have achieved natural immunity. Slide 68 shows that the market during this time, if you look at over the last 2, 3, 4 months, has barely been affected by this, all right? And the reason is, as we discussed last time, as long as there remains an effective vaccine that works against all these variants, and the vaccines that are right now being used in India or elsewhere in the world, they're all shown to be highly, highly effective against these various variants. Yes, the infections still occur, but the vaccines are effective enough to prevent worst case outcomes. And as long as that remains the case, the economies around the world are not going to be materially impacted for materially long period of time, and hence the markets are going to, as from a market's perspective, COVID has become almost like history. So another concern last time, and that remains continuous concern and has been, I think, for donkey's years, for nearly 13 years now, is that what if interest rates were to go up, and can multiples globally come down, and so on, the markets come down globally, and so on and so forth. Look, that's not $1 million question, not $1 billion question. There's like tens of trillions of dollar question, if you will. Our view is nobody really has a clue. What you see here is over the last 40 years, interest rates have been coming down. You cannot extrapolate them to come down further, but at the same time, just because they've come down, you cannot assume or that in and of itself does not mean they're going to go up. Our view has been, though again, all these macro views don't form any basis for our investments, because we don't believe any money can be made that way. But we think there is a logical argument, which I'm sure you've heard before from us, that because of the technological innovations over the last several decades, inflation expectations productivity has considerably been boosted in all spheres of life, and hence inflation expectations are extremely low. The long-term inflation expectation, because what matters is the long-term inflation expectations, not what is inflation this year, last year, or next year, right? And hence, since inflation expectations are low, interest rates are low. And since over the last 3 months, if anything, interest rates have fallen from 1.5 to 1.75 that they were last time when we met, to around 1.25 at present. If we go to the previous slide, number 60, This worry of interest rates has been at the forefront for at least last 13 years, since September 2008, after Lehman crisis, when Fed cut rates. The names changed over time. There was QE. For the longest of the time, people kept talking about QE, QE, QE. Now QE seems to be forgotten, dead, and buried. Then there was taper tantrum and tapering, 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 tapering. Everyone talked about tapering. Now nobody talks about tapering. Just now, liquidity is what people are generally worried about. And as I discussed on the prior slide, there is quite plausibly a logical rationale, rather than attributing it merely to Federal Reserve or other central bankers keeping interest rates artificially low or anything. We don't believe in that line of argument. For 13 years, that argument has been false. If it has been false for 13 years, macro gurus, doomsayers, they've missed out uh, one of the biggest bull markets in the global equity markets, based on that misplaced theory. If we go to slide 46, now turning to more pertinently, what's happening with the corporate sector. Last Subsequent to our last discussion, corporates reported the fourth quarter numbers, and they came in fairly healthy, quite a strong earnings season, and the year ended up 14%, one of the strongest earnings year for earnings from fiscal 2011. 14% earnings growth would have been unthinkable 12 months prior, in March or April of 2020. And expectations were for earnings to be down 25 to 30%, but it instead ended up being plus 14%. Now, expectations are for earnings to grow at 30+% over the coming year, and then continue to grow mid-teens. So we think the 30+% number looks like a stretch. It might have been more reasonable an expectation if the FY21 number had indeed come to be minus 10, 20, 30 some percent, as was expected in March, April. On the back of a strong 14% year, it will be very happy if market delivers 34% growth, but the team believes that could be a stretch, and more reasonable number can be again in the mid-teens or so. If we go to slide number 47, what you'll see that what has characterized the corporate earnings growth is market share gain, particularly by the listed players, which tend to be in their respective sectors the largest of the players. So I'm not only talking about the largest of the players being in the portfolio or the leaders being in the portfolio, but when you think of say PVC pipes or paints or jewelry as a sector, the listed players tend to be the largest players. There is a long tail of unorganized mom and pop stores which are losing market share. And that is why, despite a weak economic growth, the corporate sector delivered very robust earnings growth, because they gained market share. That was one key characteristic. And also, as you'll see from the right-hand side, top box, margins improved as well, as expense control were exercised, keeping in mind a very weak environment, but the environment turned out to be better for the corporates than what was envisaged. Obviously, this margin expansion may not be entirely sustainable. Some of it might have to be given back as those unorganized players come back once the supply chain issues are sorted out. Finally, if we go to slide 35, from a longer term perspective, we continue to expect corporate earnings growth to mirror nominal GDP growth, and hence equity market returns also to mirror more or less nominal GDP growth plus maybe dividend yield. So think of it as in our team's expectation, about 5 to 7% real GDP growth rate, approximately 4 to 5% GDP deflator, that would lead you to about 10 to 11% nominal GDP growth rate. Add to that the dividend yield. So think of about 11% or 10 to 12% return over time from equity markets. The team obviously hopes and targets to do a lot better as it has delivered historically, that Ramesh would go over in a short while. But before I turn it over to Ramesh, I'll just like to quickly refresh for everyone's benefit the approach of the team in 2 minutes. So to generate strong performance, we believe it's very crucial to have focused investment culture, what we call performance first culture, meaning that everyone on the team is driven towards the common goal of generating highest returns for our clients compared to anyone else in the peer group. And it is founded on these pillars of team philosophy, process, and portfolio construction, which are aligned with one another, meaning it's the stock selection based philosophy. To go with it, we have the best team of stock pickers in the industry, implementing a time tested process at the core of which is our OPCO FinCo framework, and all along maintaining, from a risk management perspective, a balanced portfolio. So next slide, to start with the team, it's the most well-resourced team. You'll see here 18 members at an average more than 10 years of experience. We have recently, during this month, 4 members additionally who've joined us, but that's not included as it's end of June presentation. Not to go into details, but it's a deep bench of seasoned investors with extensive global experience. As Prateek pointed out earlier, we have a unique team within team approach where at least 2, usually more than 2 people are covering the same sector, same industry, in the same stock. And you'll get a flavor for the team within team approach later during this call when you hear from some of those teams. If we go to next slide, the shared philosophy is that outsized returns are earned over time by investing in great businesses at attractive valuations. What we consider as great business is one those that possesses these attributes of superior returns on incremental capital, scalable and well managed, both in terms of execution and governance. These are born out of the fundamental value equation, which is that value is equal to present value of future cash flows, as is shown at the bottom, value of business equal to cash flow divided by R minus G. We conduct over 2,000 meetings in any typical year collectively as a team to assess these attributes. When we find such companies, it's imperative to value them using a logical framework and buy them only when there's substantial upside to fair value. So valuation is very important element of the approach, but we don't look at PE multiples at all because PE multiples are distorted and misleading. Hence we focus on cash flow based approach, particularly our own OPCO FinCo framework, which is aligned with the philosophy that we just talked about. So if we can quickly go to refresh people's memory on the next slide. Any company we break into 2 sub-entities, FinCo and OPCO. FinCo is where all the physical assets and working capital are housed. OPCO is where we assign the revenue and EBITDA from which it is deemed to pay a operating lease cost and a working capital financing cost. And after paying tax to the government, what is left is nothing but excess ROIC related free cash flow. And the present value of that, of OPCO, is the value of excess ROIC in the business. The FinCo is nothing but merely the value of the invested capital in the business. So we get very insightful takeaways when we break any value of any business into the 2 components as denoted in the first equation of the bottom box, where enterprise value is equal to FinCo plus OPCO. And once you rearrange the terms, you get the bottom line equation, which is price to excess ROIC. So it is PE, but not price to earnings, but price to excess ROIC, which we believe is a more logical apples to apples comparison between companies within a sector and even across sectors. So the DCF value as from the first equation and the price to excess ROIC multiple as from the second equation, those are the 2 key metrics we use for valuation. At this point, I would like to pause and turn it over to Ramesh to take it from here, talk about the performance of the portfolio as well as the composition.
Good afternoon to all the participants. We'll start we're talking about the White Oak Pioneers PMS performance. This strategy has been, the track record is now available for a little over 2 years. As you can see, since inception, for a little over 2 years, we have outperformed the market by 9.77% annualized. And if you look at, since we outperformed in 2019, 20, and the first half of 21. While since White Oak has started and started offering the AIF product in late 17, we've seen significant headwind in our portfolio because of small caps and mid caps. However, this first half year, the small cap, mid cap has been a relative tailwind to our portfolio after 3.5 years of headwind. So that's been the change in the markets. However, there's a very different attribute that has emerged in the portfolio.
Ramesh,
yes?
May I request to speak a little louder? There is some disturbance in the line, so your voice is not coming out clearly.
Sure. Yes, so I hope now it's more clear now.
There is some, yeah. Let's continue. Just speak a little louder.
Yes. So let's now, talk about, so the performance of small cap, mid cap has been a tailwind to our portfolios in the first half of 2021, while it has been a tailwind, headwind for last 3.5 years. However, as you're all aware, one key tenet of White Oak's, performance first culture is always having a balanced portfolio. And balanced portfolio is something that's a key attribute of our portfolio. While in the first half of 2020, the defensive part of the portfolio had done well, and the cyclicals like financials had suffered. During that period, White Oak had significantly outperformed the market. And this year, the first half of 21, the pro-cyclical sectors, as you can see in the slide, that the best performing sectors have been materials, which has largely been metals and cement, industrials, and utilities, which largely comprise of PSU companies. So the last 6 months has been a very strong, pro-cyclical movement in the markets. And as you're aware, a balanced portfolio strategy always has a good balance between pro-cyclical sectors in the market like financials, industrials, materials, and defensive sectors in the market like consumer, technology, healthcare, telecom. So the last 6 months has been a one-sided market, would have been a large headwind in our portfolio. However, this period, the last 18 months, strongly continues to demonstrate our stock picking ability. But despite such a large tailwind, we have been able to outperform the market strongly, and the entire performance has come through stock selection. So despite this headwind, our performance through stock selection has been very strong. While we have outperformed till June by the market by 2%, year to date, we are outperforming the market by 4%, despite managing a very balanced portfolio. So this continues to demonstrate, the stock picking ability of White Oak. Moving on to what stocks have done well in our portfolio, the top 10 contributors and detractors. Obviously, since technology, we have generated a lot of alpine technology. Some of the large outperformance in the first 6 months have been technology stocks. But then there are stocks from a variety of industry sectors. Dixon is electronics manufacturer, Bajaj Finserv and Cholamandalam are financials, Navin Flooring is chemicals, Garware is industrials, and Astral is building material. So again, the same trend continues to play out, that our top 10 contributors, even in a very short period like 6 months, come from a variety of industry sectors, which has always been the key tenet of our way of managing portfolios. Of course, in terms of detractors, some of the consumer names are large detractors over a 6 months name, simply because consumer has been the weakest performing sector in the last 6 months in the market. And talking about stocks, individual stocks, you are all aware, Intellect Design was a small position for us when we invested 3.5 years ago. The stock has done exceedingly well. It's emerged as a top 2 players in the world in certain products in their transaction banking solution, and is gaining increasingly market share in their consumer banking and insurance products globally. And then Dixon, which is the company which is India's largest and best managed electronics manufacturer, continues to execute exceptionally well and continues to benefit from the tremendous tailwind of the PLI schemes that the government has announced in the last 15 months. Moving on to the key changes in the portfolio during the last quarter. The key changes in our portfolio in terms of additions have been ICICI Prudential Life Insurance, which is one of the best run life insurance company. Again, this company has made a significant transition in the last few years, moving away from linked insurance product to more protection-based products. And we found the valuation very attractive and the business mix is changing very positively. And Eicher Motors, we are very enthused by the strong product pipeline of new launches that are likely to get launched in the next 2 years. We have made complete exits from L&T Infotech. Many of you who have been investors with us are aware L&T Infotech has been one of our best performing stocks since inception. However, in our view, we had achieved fair value and we have allocated to better opportunities within the technology space. Same logic applies for HCL Technologies, where we have reallocated the capital to better opportunities in the market. In terms of changes in portfolio weights across sectors, there's actually, in fact, no material change that I would like to call out. There have been very minor changes in consumer discretionary because we added a stock like Eicher Motors. Materials, the weights have gone up because of more investments in chemicals. And there's been minor changes in decreases in financials and information technology. Looking at how our portfolio is positioned in the next slide. Next slide, please. Thank you. So as you can see here, our PMS Pioneers portfolio has 50 stocks. So we always articulated, we will manage diversified portfolios. And Prashant, in another earlier quarterly calls, had explained in detail why a diversified portfolio is a better strategy to capture alpha in the Indian market. And we continue to demonstrate, that this strategy has been working for us. In terms of sector weights, in terms of market cap, 55% of the portfolio is in large caps and 44% is in mid caps. So there's been no material changes. As we have always articulated, for this strategy, we expect 50 to 70% allocation to large caps and 30 to 50% allocation to small cap and mid cap. And we continue to invest in the best opportunities across market caps, in large caps, mid caps, and small caps. Again, sector allocations, as I've explained in the previous slide, there haven't been major changes in any sector. We continue to have a diversified portfolio across sectors and a balanced portfolio where we have sectors like financials, industrials, materials, which are pro-cyclical, and then counter-cyclical sectors like consumer, pharma, technology, and IT services. So that's on the portfolio, composition. Finally, moving on to the long-term performance of White Oak as a manager. So the India Account Fund is the first strategy that White Oak launched on 1st September. We are about to complete 4 years in 3 months. And as you can see, for the last close to 4 years now, we have delivered, outperformed the market by 11.16%. This is despite the fact that half of our portfolio on an average has been in small cap and mid cap, which has seen quite a headwind in the last 4 years. And yet we continue to deliver best-in-class alpha and continue to be a top 1 percentile manager investing across market caps in India. I'll stop for here. Thank you.